So the third report we're looking at in this very short series is the cash flow statement. And why the statement is important after looking at your income statement and your balance sheet, which technically shows you your whole business. So you're probably thinking, why would you have a third report if I've seen my income and I've seen my expenses, seen my assets, my liabilities, and my store of value? What else do I need to see? And the reason a cash flow statement exists is very simply because accounting works on what is known as the accrual system. It's a very fancy way for saying that everything has been entered into your accounting system according to the transaction date. So if you have an invoice for stationery and the invoice is the 3rd of March, it'll be entered into your accounting system on the 3rd of March. If you sell something to a customer on the 10th of March, that invoice will be entered on the 10th of March. But the payment might happen on a different day. You might sell to a customer on the 10th of March, but they have 60 days to pay. So they're only going to pay on the 10th of May if they pay on time. Maybe your supplier for stationery has given you 30 days to pay. So you got the invoice on the 3rd of March, but you only have to pay them in 30 days' time. And some are 30 days from month end, so you'll only have to pay them on the 30th of April. So your payments, your cash movement does not match the information sitting in your income statement, because your income statement is running according to the transaction date, but a lot of those things have not been paid. A cash flow statement shows the actual movement of cash in your business, whether it is from a sale or an expense or from an asset or a liability, which is not going to show on your income statement either. So there will always be a discrepancy in your business between the profit sitting on your income statement and the actual cash you have in the bank. They never match. And your cash flow statement gives you a better idea of why. Where is that money coming and going? And why is that balance sitting in the bank account? So your cash flow statement shows you the flow of cash in your business, not your net profit or your income or your expenses or anything like that, because cash can flow in different ways in a business. It can come from you as a loan. It can go to you as a loan. It can go to a supplier. It can come from a customer. It can go straight to an expense, or you can purchase an asset or sell an asset. There are a lot of different ways that cash can flow in and out of the business that are not related to the income statement and are not easily seen on the income statement or the balance sheet. And that is why you look at a cash flow statement. And what you want to see on a cash flow statement is preferably more money coming in than going out. And you can also have a quick look to see where the bulk of the money is flowing in and out. Is it coming mostly from customers, or are you putting a lot of money into the business? If the amount coming in from you, in other words, going to director's loan account, is bigger than the amount coming in from accounts receivable, you might want to look at why. That is the reason you would look at a cash flow statement, and you can ask your accountant to explain the flow of cash to you in your business and whether they think this is a good reflection or not. But that is the cash flow statement. And in the next video, we will look at the trial balance.